Many people think finances are confusing, particularly at a complex place like the University of California, San Francisco. In truth, understanding finances can be quite easy if you start with a simple model. Let's imagine 10 of us decide to open a small bakery. The first step is to ask everyone to contribute $100, which totals $1,000. Let's call this sum the owner's equity for a new business, the UCSF bakery. Obviously, $1,000 is not enough to launch a real bakery, so let's go to the bank to borrow some money. We convince the bankers that we have a great business idea, and they happily loan us $99,000. So now, with our initial $1,000 and our loan, we have a total of $100,000, enough to get started. How much is our company worth? Surprisingly, just $1,000. That is because if we shut the business down, we would have to pay the bank back its $99,000. With our owner's equity, our next step is to buy stuff, such as a bakery space, an oven, and a nice truck to deliver the bread. These are called assets. If we spent $60,000 on assets, then $40,000 remains. Again, how much is our company worth? Still $1,000. If we shut down the business today, we would have to sell those assets to pay back the loan. Now that we are ready to operate, we will need to spend more cash to make bread. We buy flour, hire a baker, and get wrappers with a cute UCSF logo on them. Then we start baking. Once we have produced a mountain of delicious bread, we sell it. Say we spend $25,000 to make the bread, and we sell it for $26,000. How much did we make? A $1,000 profit, which we can add to our owner's equity. What is the value of our company today? $2,000. We doubled our money. We can start the bread-making cycle again, or even sell our bakery for $2,000. We would then walk away with $200 in each of our pockets, instead of our original $100. This story of a bakery and the way money moves through it is basically finance. If you can understand the funds flow of a simple bakery, you can understand how money flows through a university. We all have financing, meaning where our money came from, our owner's equity and our liabilities, which is what we owe. We all have investing, which is a measure of stuff, the money that we hold in cash, and the value of our assets. We all have operations, showing how we spend our funds and bring in revenue. The model is the same for UCSF, for Tesla, or for Amazon, and we all report these same categories in our financial reports. U.S. businesses use 3 standard financial statements to describe their financial flows. One is called the balance sheet, which reports on the totals of financing and investing. In our bakery, we had $1,000 in equity, $99,000 in debt, and total assets of $100,000. The sum of equity and debt always matches total assets. The two must always be in balance. Another report is the income statement, or P&L, short for profit and loss. This shows revenue minus expenses, which is a measure of how well operations are performing. In higher education, we call this our statement of revenue, expense, and change in net position. The third report is the statement of cash flows, which tells how much money comes in or goes out and why. For example, if you are getting a lot of cash from financing, there is a good chance you have been borrowing. In contrast to our imaginary bakery, UCSF is a public, not-for-profit entity. A business tries to maximize profit for private gain. Nonprofits have a different focus. If UCSF is fortunate enough to bring in revenues that exceed our expenses, we dedicate any surplus money to expand activities that support our core mission of research, education, patient care, and public service. Am I saying our goal is to spend as much money as we can? No. But the more efficient we are in controlling costs and increasing revenues, the more total service we can provide to society to advance health for all. UCSF has made huge progress in recent years in achieving its mission. Like a successful bakery, strong finance helps make it all possible.